Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you the pros and cons of an annuity contract or any types of annuities out there. I guess the first question that individuals have whenever they look up annuity is exactly what is it and why may it be beneficial for your specific situation. Well, what happened was back in the 1980s and 90s, you had interest rates were in double digit figures. An individual is able to take a large lump sum of money that they've accumulated for their retirement, have that large lump sum, that kind of think of it like a bucket, place it into a fixed account, and then they would get some sort of double digit interest return from that fixed account, understanding that this fixed account was very safe. Their money that was gaining interest was very preserved and protected, and they would just be able to live off the interest year by year by year. Meaning, if someone had $1 million and they wanted to leverage a fixed account, such as a bank CD, a treasury bond, a fixed annuity, whatever that is, if they were making 10% on their money, then they would get $100,000 every single year for however length that that contract was. Let's say it was a 5-year contract, and then after the 5 years was done, they'd be able to walk away with their full $1 million, having that completely preserved and protected. Well, unfortunately, since the 1980s and 90s, there's been some really drastic economic shifts that took place, resulting in interest rates hitting all-time lows. So now, instead of getting that 10% rate of return off of a 5-year bank CD or a 5-year fixed annuity or a treasury bond, now maybe you might see it at 1%. A fixed annuity might be paying you 2%, 2.5%. So it's that ball game has shifted, and a lot of the ways that people plan for their retirement is completely different than it used to be, than the easy path to getting to that worry-free retirement. Now, in early 2000s, individuals understood the shift with this low interest rate environment. So they thought about it and they said, okay, how's there a way that we could still try to make money, still preserve our accounts, and take off interest in the process, where we're only living off of our interest and we're still leaving our principal to our beneficiaries. And what happened was, the big mistake that was made was individuals would leverage something known as mutual funds, or just risky type accounts, not safe type accounts. And what this does is it correlates to a term that I use in pretty much every video, because I really want to hit home with anybody that's watching this, is reverse dollar cost averaging. And what this says is, if you have that same individual that accumulated $1 million and they said, okay, wow, I can't utilize those fixed accounts anymore. I now have to throw my money in the market and hope that the market's going to do well. As long as I make my money, if I diversify it in a conservative way, I shouldn't outlive this money, right? And this is where the mistake has been made, because if you take this bucket and those individuals that placed it in mutual funds in early 2000s, they were saying, okay, well, whenever I research online, whenever I research in books and financial publications, it's telling me that a safe haven should be about 4%. I could leave my money in the market and take out about 4% per year, and I should be able to get to my retirement destination successfully. Well, since that point in time, the market has been doing this number. It's been extremely volatile. We've been having very large drops one year, very large gains the next. But what happens is, it's not that consistent flow, so you cannot predict how to utilize this constant 4% every single year. And with reverse dollar cost averaging, it really hones in on any sort of risk type aspect. What I mean by risk is, if something is not guaranteed, if something doesn't have a legal reserve structure, some sort of safety net behind it, then there is risk there. And when it comes to retirement, you have to think of this as your livelihood. You do not want to have risk in your retirement. So this is what happens with the individual that utilize that sort of planning process, utilizing their risk during retirement. And what would happen is, they'd have to constantly pay mutual fund related fees. Typically, mutual fund related fees are hovering right around 1%. Could be a little bit less, could be a little bit more. Then on top of it, you had financial advisors, which were wealth accumulation specialists, and they were wealth accumulation specialists that were trying to suggest ways on how to utilize retirement income planning. Now, myself, my company, and other individuals out there throughout the nation, we specialize on retirement income planning. So a lot of our things are very safe and consistent. But we understand exactly that correct path when someone's accumulated their assets, how to preserve, protect, and make sure that you're receiving lifetime income streams from that money so that there is no question mark in retirement. You have pure certainty of exactly what's going to be happen at that specific point in time. So back to that individual that just basically used the wealth accumulation specialist, that guy knows how to accumulate your money. So he says, listen, we're going to leave it in the market based upon my algorithms, based upon my expertise. We're going to try to grow this money. But that's the whole factor, is they're going to try to grow that money. There is no guarantee with that money. In order for him to make his recommendations, whoever that advisor is, they're going to charge you something known as a wrap fee. This wrap fee could be about 1% if you're lucky. Could be high as 2.25%, 1.4%. That's the typical wrap fees that advisors charge. So you don't only have, before your bucket even starts doing anything, you already have 1%, minus 1% because of the mutual fund related fee. You already have minus 1% because of the advisor fee. And then now your money could try to go into the market. Well, what happens if you have a downward market loss? And this is what happened in 2008. The average portfolio lost 57%. Let's say if you just had 10% drop in a given year, which is very realistic, especially in today's times, and you took out income of 4%. Well, you would have taken out income of 4% that first year, would have resulted in $40,000, but you would have ended up losing 10% plus 1% plus 1% worth of value, which would be $160,000 worth of value that 1 year, making your new account value go from $1 million all the way down to $840,000 in one given year, even though you only took out $40,000. So what annuities do, and kind of the pros about annuities, is they give you that income, they give you that peace of mind factor to make sure that you could get from point A to point B successfully, and you're leveraging an insurance company that has a legal reserve structure, making sure that your money is safe, making sure that company goes under, you have certain tiers of safety that could back up your money. But at the end of the day, what they're doing is they're guaranteeing you a retirement income stream that you could never outlive, or you and your spouse could never outlive. And that's the most basic form of an annuity. And that's what, and I guess I'll pull up a new screen. And this is what explains something known as an immediate annuity. And simply put, what it does is you're giving the insurance company a lump sum of money, understanding that they are going to, as long as you give them that lump sum, they're going to pay you income streams on either a monthly basis, an annual basis, a semi-annual basis, however you want to receive it, but they're going to pay you income that you can never outlive, or income that you and your spouse can never outlive. Now, I actually don't like immediate annuities. I think that you lose too much control in the process. What I mean by that is if you take your $1 million example, and let's say you're 65 years old, it's all based upon your age, it's all based upon your sex. Reason being is because the insurance company isn't just going to say, okay, out of whatever age comes to us, if somebody's 60 years old, yeah, we're going to give them 6% interest, as opposed to the guy that's 80 years old, and we're only going to give him 6% interest. What they want to do is have a larger incentive. It's not a large incentive for the company to give you a favorable guarantee if you're younger, because they understand that you have a long time horizon to live, as opposed to that 80-year-old that, mortality rate speaking, only has about 10 years left to live. So that's how they determine how much income you're going to get. So maybe that 60-year-old out of that $1 million is going to be guaranteed $50,000 a year. But that 80-year-old that's giving $1 million, they might be guaranteed $110,000 per year. And that's the major difference. It's just basically because off of the insurance company's standpoint, where exactly does it hit that certain price point where they're able to still be profitable and give you a guarantee and be able to provide that guaranteed income in the process. So if we just take this example of the individual that was 60 years old and they placed $1 million into an immediate annuity, and let's say the insurance company said, okay, we're going to pay you $50,000 per year. Well, this might be good because you say, okay, if I just keep living and living and living and living and living, what happens when I hit age 80? Which would be exactly in 20 years? And these are just a hypothetical example. Some companies might offer you 5.5%, 5.2%, whatever that is. But essentially what you understand is you're leveraging the insurance company, saying that they have to give you a guarantee of $50,000 every year. And every year after age 80, that you would have outlived this money if you're just taking it simply from a bucket of money, this insurance company is still on the hook to pay you that $50,000. It's contractually guaranteed off of that insurance company that you're utilizing. Now, what exactly happened, which sounds fine, right? If you live to 85, 90, 95, 100, you were leveraging the insurance company, and they were meaning that they were paying you more money than what you placed in there. Now, what about for that individual that passes away? Let's say they're age 60, they gave the company $1 million, and now the company gives them $50,000 per year, but then that person only lives for 5 years. Well, they would have received $50,000 for 5 consecutive years, meaning that they would have received $250,000, but now the insurance company wins because they walk away with $750,000 worth of value. And this is what I don't like about immediate annuities. That's the cons to it. When you utilize an immediate annuity, you're surrendering that amount of money. If you're giving a lump sum, yes, you're going to receive a contractual guarantee, but you will not leave anything to your beneficiaries. Now, there's different forms of immediate annuities. You can have period certain immediate annuities, meaning like they would pay you $50,000 per year and also guarantee you that you're going to have at least 10 years of payments that will come to you. If you pass away in year 5, then you have another 5 years that are going to get paid to your beneficiaries. There's different nuances with these products, but the very raw part of an immediate annuity I do not like. And that's why you're never really, if you call into the office, you're never really going to see myself or any of my advisors really push that immediate annuity route, because the insurance company's always going to win. They're going to leverage your money against you. Now, you have other types of annuities out there which I do like. I do find that it's very favorable for the correct individual. The first type is something known as a fixed annuity. And how this works is it's just like any sort of fixed account that you might be familiarized with, such as a bank CD or a treasury bond. What happens is you could have your $1 million that is sitting there, purchase a fixed annuity, and understand, and maybe that fixed annuity for like a 5-year fixed annuity might pay you 3%. So you understand for every year you're going to receive 3% of interest on your money. So the first year you're going to receive 30 grand into your account. Next year is going to be 3% of $1,030,000, and it goes more off of a compound interest type factor. And this serves its purpose, and it did serve its purpose in 1980s and in the 1980s and 1990s. Reason being is because you could leverage a fixed annuity being offered through an insurance company that would typically pay you about 2 to 3 times higher than a typical bank CD. That would only be offering you, like right now, bank CDs, you'd be lucky if you find a 5-year bank CD paying you 1.2%. And right now, with fixed annuities, you'd be lucky if you could find one paying you about 3% per year. So it's all the same sort of concept. Both have some form of legal reserve structure into it, except for a fixed annuity is owned through an insurance company, and insurance companies cannot offer bank CDs, just like a bank CD is offered through a bank, and the banks cannot offer fixed annuities. So just understand, it's just for that very safe individual that says, okay, I want to place my money in here short term, and I want to know precisely how much I'm going to receive. And this is a type of deferred annuity. So this is a tax deferred annuity. So understand, the other immediate is obviously immediate annuity. The fixed annuity is a deferred annuity. Now, what are the cons to the fixed annuities? Well, simply put, if you're placing your money into a contract for 5 years, then you understand that you can't touch your money, you can't touch the full amount for 5 years. Also, another con is currently interest rate environment is so low. You'll be lucky if you could find a product with about 3% rate of return that will be paying you a fixed percentage rate of 3% year by year by year. So, with those two cons, that could really make the difference between whether or not you want to go that fixed annuity route. But rather than an annuitization, because what happens is all annuities, they offer you some sort of annuitization factor, and this is where the confusion lies. What this means is that same concept where you're paying an insurance company and the insurance company could pay you a lifetime income stream, every single annuity offers that. That's the whole premise. That's the shell. That's the inner core of an annuity. But you don't have to annuitize all contracts, and that's exactly what we recommend against is annuitization. Reason being is because when you annuitize and you're completely surrendering your money, then now you're at the insurance company's discretion. So if you have a fixed annuity, you could just play by the rules and get that fixed interest rate, fixed interest rate. After 5 years you're done, you take that larger bucket of money and then you roll it over into something else. So you don't have to stay within that fixed annuity. If that company then offers you a better deal in 5 years, then obviously you could roll it over into that new product line. But my recommendation is you never annuitize a fixed annuity. Now, the next type of annuity that I really recommend, I recommend especially in today's times in this low interest rate environment and but potential upward market movements, I recommend the fixed index annuity or the hybrid annuity. And reason being is because of that control aspect. If you're looking for an account, just like that bucket of money, that $1 million, and you don't like the fixed interest rates that are currently paying you 3%, understanding that inflation could beat out that 3% in a given year, and you want to have your account have safety, preservation, and eliminate any downward market losses, meaning that your accounts do not become affected with downward market losses while participating in upward market growth, this is where a fixed index annuity works very, very well. What I mean by that is kind of think of that $1 million, but now we're going to put a little shell over it. There's no guarantee on exactly what your interest rate is going to be year by year, but it's going to be invested within a stock market index of your choosing. Typically, each company offers you about 5 different options. Some might be like an S&P 500. Another one might be a Dow Jones Industrial. There's different types of allocations out there. Now, with the fixed index annuity, year by year, it goes by a 1-year point to point. So it says, okay, out of that year, out of that index that you chose, did that index go up? If the index went up, then they're going to execute and you're going to receive a portion of those gains. The next year, did that index go down? If that index went down, they do not execute and you receive a gain of 0%. So essentially, if you're looking at a market and the market does one of these numbers, with a fixed index annuity in a hypothetical example, you would increase whenever the market goes up. Whenever the market goes down, you're going to decrease. You're going to stay exactly the same. Whenever the market goes up, you're going to increase. Whenever it goes down, you're going to stay exactly the same. Whenever it goes up, you're going to increase. Whenever it goes down, you're going to stay exactly the same. So it allows you to have that safety and consistency in your account value year by year by year. Now, the next type of annuity out there, which I really like to leverage because I believe that it gives the client control while allowing their money to grow whenever the market increases, flatline whenever the market goes down, and also provide a lifetime income stream that they could never outlive. Now, anything that is not taken from that lifetime income stream, just like the immediate annuity example, if you were getting paid, if you were getting offer of $50,000 per year from your $1 million, and let's say that bucket of money, let's say you only lived for 5 years, and let's say you never had growth into that bucket, well, you would have taken out $250,000. With the hybrid annuities, because we're leveraging, it's a fixed index annuity with an income rider. That's the most important aspect to understand, the income rider. Because what happens is you're executing it through the income rider, you're not annuitizing your money. So in this same hypothetical example, if you would have taken out 250, the market would have remained exactly the same or would have crashed every year for those 5 years, you would gain 0%, 0%, 0%. You would have taken out 250, your account value would be sitting at 750, and if something happened to you, you passed away, your beneficiaries will now receive the 750,000. On the opposite end of the spectrum, let's say if you just kept living and living and living and living and living, and all of a sudden you got past age 80. And let's say that the market never gained again and you just kept taking out 50,000, 50,000, 50,000, 50,000, and you were 60 years old. So you would have outlived, if you would have had this money in a bucket of money, and you would have tried taking out 5% from that bucket, you would have outlived that money. There would be no guarantee there. With the hybrid annuity, with that income rider, it allows you to execute that income and have it forever. So if you had it on your life only or on a joint life only, whatever option you choose, you could have that $50,000. Let's say you're living in your 80s, your 90s, your hundreds. $50,000 is still contractually guaranteed to go to you through the insurance company when you set up that contract at inception. So, that's why I like leveraging a lot of the hybrid annuity aspects or the fixed index annuity aspect, especially in today's times. Reason being is because nobody knows if interest rates are going to increase back up, or when they do increase, When is that going to happen? Is it going to happen 10 years out from today? Is it going to happen 15 years out from today, 20 years out? And you don't have that long time horizon for those individuals that are turning age 60 or 70 and they want to start taking retirement income. This is why I like to leverage the hybrid annuity aspects. Now, there definitely are some cons with these things though, because the company has to give you a guarantee. They have to give the client a guarantee. So when they're giving you a guarantee, they're saying, okay, whenever the market goes up, you're going to gain into your account. Whenever the market goes down, you're going to gain 0%. We're going to also, if you're receiving a fixed index annuity with an income rider, we're guaranteeing you a lifetime income stream that you could never outlive. They might charge you. You might have to pay a fee for that. Some companies offer a rider charge. Some companies don't have a rider charge. But typically, all of these rider charges are less than 1%. So it's a lot less than any sort of mutual fund, and definitely less than any sort of mutual fund and wrap fee from an advisor. So, but what happens is that fee is the only negative that could potentially happen to that account value. Meaning, if the market keeps crashing, and you were in a hybrid annuity, then, and let's say your rider charge is 0.50%, well, then you understand that 0.50% would be coming out year by year by year. When you outweigh the pros and cons, I mean, the pros, I think, completely supersede any of those cons. The other aspect is time horizon. Just like if you threw your money into a bank CD, let's say you threw your money into a 1-year bank CD that's paying you 0.20% right now, or you had a 5-year bank CD that's paying you 1% right now, why exactly can they give you a higher rate of return off of that 5-year bank CD as opposed to that 1-year bank CD? And the reason being is because of the time. The amount of time that your money is locked into there, they could give you a higher guarantee than with that lower time horizon. That's the same concept with the fixed index annuities. Typically, and also the hybrid annuities, typically their contracts go about 10 years out, meaning that you have some sort of restrictions within the first 10 years. After 10 years, then it's 100% liquid. So whenever you're you're interested in getting set up with an annuity and possibly a hybrid annuity, you have to determine, say, listen, if I'm getting set up here, I know for sure what my retirement destination is going to be. I understand all the pros, I understand all the cons, and when we're setting it up, you know exactly what the worst case scenario is, and then you also understand that, you know what, I don't want to throw all my money in there and then gank all my money out the next year or in 3 years, because that's when these things do not work. It works specifically for the correct individual that's looking to have safety, preservation, upward market growth potential without any downward market losses, and also provide a type of personal pension aspect through their lifetime income rider. One of the things that I always say at the end of every video is I say, give our 1-800 number a call. We implemented 24/7 customer service. We are A+ rated on the Better Business Bureau. The reason being is because of our methodical process. We try to make sure that this is very systematic. We try to make sure that we try to give you good advice off of your goals. If you have specific goals, and let's say what you're currently doing is getting you there successfully, we're going to tell you, listen, don't leverage an annuity. Don't leverage anything else regarding a retirement income plan. You do not need that. This is for the individual. Should call our office if they say, listen, I do not know what I have. I do not know my options out there. I understand that I have a 401k or I have an IRA or a cash account that's sitting here, but I want to have that certainty in retirement. I want to have that certainty that I'm not paying a lot of these money, that I'm not paying my money towards fees. I'm not paying my money's not susceptible to downward market risk. It's not susceptible to any advisor fees. And I want to know how to get from point A to point B successfully and in a very safe manner. And that's what we try to do. We try to help dissect this information. We create videos for you. We give you personalized information, personalized reports, and that's why we've never had a complaint, with our company, and why we are the best rating you could possibly have on the Better Business Bureau. I want to thank you very much for watching this video. Please subscribe to our YouTube channel. Reason being is because we try to update videos every week, every couple of days, to make sure that you're getting the most recent content. And you could always have access to the newest videos just by subscribing, and you always have it going to your email inbox or your YouTube account. So it's very important. Once again, my name is Derek Afasi, owner of Afasi Financial Group. I want to thank you very much for watching this video, and please be on the lookout for some of our other videos. Thanks, guys.